Hello everyone. Is the Bank of England getting ready to cut rates sooner than expected? The latest UK labour market data suggests that the pressure is building and the pound is already reacting. Let's break down what this means for GBPUSD. The unemployment rate has climbed to 5.2%, the highest since 2021. At the same time, wage growth has slowed to 4.2% year on year. Now, why is this important? Because wage growth is key driver of inflation. When wages cool, inflation pressure eases, and that gives the Bank of England more room to cut rates. Remember, the Bank of England held rates at 3.75% in February, but in a very close 5-4 vote. That tells us committee is already divided. With weaker labour market data, markets are now leaning towards a March rate cut. In fact, most economists expect at least one reduction soon, with another possibly later this year. Attention now turns to inflation data. Headline inflation is expected near 3% and core around 3.1%. Still above 1% BoE's target. If inflation also cools, rate cut expectations could strengthen further. Technically, sterling slipped around 1.3561 after the labour market data released. Looking at the chart, we can see that GBPUSD is consolidating inside a symmetrical triangle. Here's the key level to watch. The lower boundary of this triangle aligns closely with 50-day SMA. A clear break below this zone could open door towards 1.3437 levels, where the 200-day SMA sits. On the upside, 1.3868 remain strong resistance. Unless that level is reclaimed, rallies may face selling pressure. For importers, 1.3515 region near 50-day SMA is an important zone to consider. Meanwhile, exporters may look to hedge around levels closer to 1.37 and above. So, the story is clear. Cooling labour market data is strengthening rate cut bets, and GBP is feeling the pressure. The next big test is inflation. Stay tuned because that could decide the pound's next move. Thank you.